So it's a challenging and unprecedented time for all of us, and I really think you know, it's going to change the world. But on a positive note, I was really pleased to see on social media over the last week or so that we've got swans and fish in the canals in Venice again, and so the world is having the opportunity for a bit of a detox, which is I think a great thing. Okay, so I'm going to turn my face off now so that you can actually see the presentation, and I'm going to run through a bunch of slides. So where are we at? Well, first of all, we have to show you our disclaimer. So today's presentation is going to focus on what's going on in this currently crazy world that we're living in. Really, we're trying to help you understand how it might impact on your super and what you might consider doing, if anything. But please note it's general information only. It doesn't take into account anybody's personal situation. So if you want to discuss your personal situation, please contact us. And it is business as usual at Lifestyle. Well, semi-usual. So this is really interesting, I think. Coronavirus. When we started putting this presentation together, which was late last week, this was the situation. I am now going to drag across the current situation so that you can see what's happened. Bearing in mind, you can see there's 207,000 when we started this. This might just take a moment to load. There are now 465,900 confirmed cases in the world. So it is rapidly expanding. And if we click on Australia, you can see that there are 2,799 cases, 11 deaths. It's escalating quite rapidly. You can go and have a look at this chart. It's the World Health Organization. It's interesting to keep track of it, but I think that just puts it into context as to where we are and to how quickly things are changing. So how does it affect us and our superannuation? The spread of coronavirus has actually slowed in China, but obviously it's accelerating quite rapidly across the rest of the world. I know there were times in the last week where there's been no new cases in China, or they're claiming that the new cases have actually been imported. And please bear in mind that a lot of these slides that we're showing you are a few days old, and that everything is changing so rapidly it's impossible to keep a presentation like this up to date to the minute. But I think generally what we're trying to do is just give you a view. Sorry, I skipped past that slide, this one. So the implementation of containment measures, the loss of revenue to businesses, the inevitable loss of jobs, it's all going to create a large and more prolonged demand and supply shock for the whole economy. What's interesting is, though, that the US market was up 11.37% on their Tuesday. So there's extreme volatility in both directions, up and down. There's obviously the risk of recession, but it looks like governments are acting really quickly to reduce the spread, and hopefully that will reduce the period of time that that this impacts us for. But we're obviously in a period of fear, and I've got to say, from my years, and I've been doing this for over 30 years now, I've been a financial advisor. I've been through the 94 property crash, the 2001 flying planes into buildings, the 2008 GFC, particularly 2001, September 11 and 2008. I was quite frightened because I thought, my goodness, these are world-changing events. I'm not as frightened in this situation because I believe that the world will get over this. it will pass. And fundamentally, what I'm going to try and show you today as part of the presentation is that the fundamentals of companies are actually quite strong. So there's probably really not a lot of major things holding the market back from recovery. Whereas after particularly the GFC, there were a lot of issues. So this slide just shows us, and again, it's a little bit out of date, it's a few days out of date, but it just shows us in 2019, the ASX 200, which is the top 200 shares on the Australian share market, were up 19%. So it was a really good year in 2019. And so far this year, they're down 24%. So we've wiped off last year's gains. And I've got a few more charts that will show you similar things. Market sentiment, well, we haven't seen volatility like this since the GFC. So this is the fear index, which just shows how fearful people are, and it's up there. I think it's hit record closing highs. So fear is currently driving markets. I just will now go through a couple of really basic things, and I apologize that this is very basic, but I just want to put into context some of the things that I'm going to say in the next few slides. It's just when we're investing, there are really only 4 places that we can invest, and there's lots of derivatives of those things. So, you know, for instance, with property, there's the derivative of infrastructure and so on. But suffice to say, there are really 4 places that we can invest, and that's cash, which at the moment, I've moved this down the chart because at the moment with cash, you're getting basically no return. We have fixed interest, and obviously fixed interest returns are going to be quite low as well. We have property, which who knows what's going to happen as a result of all of this, but you know, property I think has been quite buoyant. And then we have shares. So shares are the furthest up the risk spectrum. And as you can see, property and shares are what we consider growth assets, and fixed interest and cash are defensive assets. So how will your super be impacted? Obviously, super funds make money when the assets go up, and they lose money when the assets go down. Really, the issue I think for all fund managers and for everybody at the moment is that defensive assets are not really providing us with much return. So we still have to invest in growth assets if we want to get any sort of decent return, and super is a long-term investment. So we're kind of stuck with sticking with growth investments at the moment. Super funds tend to predominantly be in growth assets. So even your average balanced fund, which is a bit of a misleading term, is generally 70% growth, predominantly shares. A lot of the My Super balanced funds are actually a lot higher than that. And in fact, the Colonial First State, for younger people, their My Super fund is 90% in shares, MLC at 85%. So, you know, you are quite exposed to growth assets. It really is important, I think, the bottom line, to know how your super's invested and to have some control over it. And that's one of the things that we've always tried to do with our clients and the companies that we look after, is to try and educate and assist people to be in control. So what should you do? I think just consider what we're saying in this presentation. Think about, you know, obviously we're not trying to provide advice. It's hard to know when things will change, but a lot of people, I guess, have the general belief that maybe they should be taking their money out of the market because it's dropping, and then they'll put it back in at a time when the market gets stronger. It's really difficult to time those things. And I've got some charts coming up that might just surprise you. So volatility is not, I don't think, really a problem for superannuation because it is such a long-term investment. If you're invested in a gear fund, you'll see even more volatility than if you're just normally invested. But then, of course, if you are in a geared fund, you've seen incredible returns over the last several years because of the market going up as much as it has. So, you know, we have strategies too, and I think it's important to be not too concerned about how you are going to cope in retirement if you're close to retirement, because we do have strategies for our retired clients to reduce volatility, and they include putting a number of years of income into defensive assets like cash and fixed interest and drawing down on that so that we never really have to sell shares at the wrong time, because you only ever make a loss from selling something when you actually sell it. If you hold on to it and the price goes back up again, it's only a paper loss. So, you know, really not necessary to be concerned about paper losses at this point of time. Sorry, I was just having a drink. This is a really confusing chart. All we're really trying to show you here is the trend of assets over the long term. So as you can see, cash is very steady, but the return's very low. Shares perform much better over the long term. I've got some clearer charts. This is a chart of the S&P 500, which is an index of US stocks. The interesting thing about this chart is that income is reinvested. So this shows you not only the growth in the shares, but also the dividends that the companies have paid. Because what we often forget when we look at these charts is that we're only looking at the value of the stocks. And as an example, Australian companies, on average, the ASX 200, which is the top 200 stocks, pay about 4.5% in dividends, and those dividends are franked. So you're really getting about 6% income on a tax-adjusted basis from Australian shares. So even though our share market may, you know, when you look at the charts, you go, well, it hasn't gone up that much. Well, every year you've been getting, let's call it 6% on top of that in dividends as an extra return. So this S&P 500 includes those dividends. The important thing to notice about this is it's a log chart. So from 2 to 500, and then from 500, oh, I've got to make sure I've got my cursor on the right screen. From 250 to 500, and then from 500 to 1,000 is the same distance, and then from 1,000 to 1,500 and so on. Otherwise, the line would go off the top of the screen, obviously, and we wouldn't be able to see it. The thing that I really want to point out is the 87 crash. That's the 87 crash here, right? When we look back on it in history, it's like, really, why did people jump out of buildings and kill themselves when it wasn't such a dramatic event? It was obviously very dramatic at the time, and similarly, the US was hit much harder by September 11 than we were, and then they were hit by the GFC. But then we've had a strong recovery over that period, and now, yep, we've dropped from the S&P was over 3,000. It's now dropped to below 2,500. But my guess would be that we'll look back on this in years to come, and it will be a blip like this. So in the long term and in the scheme of things, nothing to lose too much sleep over, we hope. This is, I think, very interesting. So these are some trading charts that I downloaded this morning, just to show you what's actually happened over the last 5 days. Now, you would think that with the death toll increasing in America and everything that's happening with this virus, that sentiment would be really bad. But in the last 5 days, 4 of the last 5 days have been positive, and the fourth one here was only very, very slightly negative. So these are what they call candlestick charts. They show you the volatility of what the market will do in a certain day. So for instance, on this day, the market went up a lot higher at one point, it went down a lot lower at one point, but it settled at the top of that green bar. And then the next day it started at the top of that green bar, went down a little bit, Actually, it went down a hell of a lot and then came back up again to end up only going down a little bit. Next day, went up a lot, came down, and so on. And that's what the case was this morning when I took this at about 8 o'clock this morning. Now, these are trading charts, so they're charts that are running pretty much 24/7 basically, because traders don't sleep. Australia, to look at that one, similar story, except we've actually had positive markets every day for the last 5 days. Obviously, the stimulus is having an impact on this, which is putting more positivity into the market. Okay, keeping track of time. So, one of the things that I think should be an encouragement to all of us is that after this market fall that we've had, our stocks have come down to below what is considered fair value. So they're now cheap, which means that it's, you know, again, from a trader, from an investor's perspective, it's a good time to be buying. This is the long-term average. And as you can see, we're quite a bit below the average. The US has dropped quite a lot. They're still below what the intended future value was. So, you know, it's an obvious thing. Obviously, when things drop in price, it's a buying opportunity. So, look, the tips really. You know, if you've got to buy a property or you need to spend some money in the next 12 months, then you really should have your money invested in areas that are not volatile, which is why for retirees we would recommend keeping several years of income in cash and fixed interest, so that you should never really be in a position where you need to sell an asset at the wrong time. That's one of the most important aspects of financial planning, really. If you've got longer time horizons, then you can consider investments that give you much greater growth potential, and really, who cares about the ups and downs over the long term? You know, we're not going to get a lot of growth from other investments over the next few years because, as you would know, cash rates in Australia are now at 25%. The US has dropped cash rates to well, 0 to 25%. So we're all on really low rates at the moment, which means that bond traders are not going to be able to buy bonds that are providing a very high rate of return. So bond returns are going to be low, cash returns are going to be low. We just have to hope that we get some decent returns from property and shares over the next few years until the markets normalize again. So look, even financial experts, I'd say especially financial experts, they all have trouble timing the market. It's really difficult for them to know, you know, the right time to buy and sell and so on. So how can we as you know, normal people that don't focus on this 24/7 know the right time to make those decisions? So I guess the moral of the story from our perspective is don't lose sight of the bigger picture. Focus on what it is that you really should be concerned about. And I know at this time it's really difficult for people, particularly people that are losing their jobs. And I mean, I'm so empathetic. I really hope that that's a short-term thing and that everybody gets back to normality as soon as possible. And frankly, I think the government doing what it's doing and acting as quickly as it has acted is hopefully going to reduce the duration of all of this. I've read a fair bit in the industry press about people who are in industry funds. A lot of them are moving to cash because they don't have advisors to talk to about what they should do. And as you would have seen from those previous slides, if you moved to cash 5 days ago, you've missed a really big bounce back in the market. And, you know, that bounce back, if that's a 20-25% bounce back, wow, that's like 2 years, 3 years of normal investment returns. So when are you going to recover that? And that's why, you know, it might seem like the easy way out when your advisor says to you, look, the best thing is to do nothing. But literally, generally it is. So that's our current advice. I just also wanted to tap on the early release of super benefits. So this is, I think, a sensible thing that the government has announced. It's allowing people to access up to 10,000 of their super if they're impacted by COVID-19. So that's 10,000 this year and 10,000 next year. For some reason, it doesn't seem to come into effect until mid-April. But it's there if people need it, and you can apply on MyGov for that release. The other thing that they've done for pensioners is they're allowing pensioners to reduce their pension payments by 50% if they can afford to, you know, have the lower income. As I said, for our clients, not so much of a concern because they're drawing from cash and fixed interest, so they're not selling assets at the wrong time anyway. So top tips to take away. It's always prudent to regularly take stock of your situation, a bit like an annual health check. Understand what legislation is. You know, just appreciate that your super's for your lifetime. It's not a short-term thing. It doesn't finish when you retire. When you retire, you just convert it to a pension, and then hopefully you live a long and healthy life, and you know, you've got it there for another 30-odd years. So it's important to have a very long-term view of what's going on. Be diversified. Try, you know, don't try and time the market because it's really hard. It's basically just gambling. Financial advice is important. We're here to help. Please feel free to contact us if there's anything that we can do. All of our normal lines of communication are open. We have a the 1300 number is still working. Obviously, the you know, everything's manned, so please feel free to sorry, I'm just reading texts that I've got a 4-minute warning, which is one of the bad parts about not being in the same office. I've got to read a text on my phone. So I'm about to wrap up. We're here to help. The office is closed. We won't reopen that until obviously social isolation finishes, but we are fortunately all equipped with computers that we can work from home, and all of our information, all of our stuff's in the cloud and everything, so we're in a really good place. Please shoot through any questions that you've got. Feel free to email us if need be, and we will notify you of upcoming webinars. We'll try and keep them relevant and interesting, and we'll use your questions that, you know, if we get good questions from this webinar, we'll answer them in the next one and build on this as a bit of a series. So stay well, everybody, stay safe, and look after each other. And as I say, we're here to help. Thank you very much.